was saying that it's a contract between two parties that gives a rise to a financial asset, of one entity and a financial liability or equity instruments or equity instrument of another party. Okay, so we are saying that you go and take a loan. To you, that loan is a financial liability, but to the bank, it's a financial what? It's a financial asset. So basically, that's what we are saying, that okay, A Limited, right, gives B Limited a loan, right? So to A Limited, right, this is the financial asset, right? Because they have gave the asset to B Limited, but to B Limited, this is a financial what? This is a financial liability, because we are saying that when we are standing in the books of A Limited is saying that B Limited is owing me, right? When we are standing in the books of B Limited is saying we are owing A Limited, right? So as for A Limited, this is a what? This is a financial asset. Then as for B Limited, this is a financial what? Financial liability. Then also, A Limited can purchase shares in B Limited. A Limited can purchase shares in B Limited, right? So in other words, we are saying that A Limited purchased shares in B Limited, right? Okay, so to A Limited, right? This is a what? This is a financial asset. This is a financial asset, right? But to B Limited, this is an equity instrument. Okay, this is an equity instrument because we are saying that A Limited can go on the JSE and say, no, we want those shares, right? Then they can purchase the shares. Those are the financial what? Those are the financial assets. Then on B Limited, they say, no. What have went up? What have went up is our share capital. So this is a what? This is an equity instrument. So this is what we mean when we say a financial instrument is a contract between two parties that gives rise to a financial asset of one entity and a financial liability or equity instrument. So in other words, we are trying to say that, okay, these have resulted in the rise or in the increase of financial asset of A Limited. But there was here an increase of financial liability of B Limited. Then there was a rise in the equity instrument of B Limited as well, right? So this can be categorized as a financial instrument. This can also be categorized as a what? As a financial, as a financial instrument, right? Okay. Then we have classifications and measurements, right? Let's look at the classification and measurements of the financial instrument, right? So we have classification and measurements. Okay. So we are saying that we're going to start with the financial assets. We're going to start with the financial assets. We're saying that financial assets, there are three ways that we can measure financial assets. Three ways measure financial assets. Okay. Firstly, a financial asset is measured at amortized cost. A financial asset is measured at amortized cost, right? In other words, here we have to calculate the present value. A financial asset is measured at fair value through profit or loss, right? Number 2. Number 3, a financial asset is measured at fair value through other comprehensive income. Through other comprehensive income. In other words, we're going to refer to this as OCI, right? So there are 3 ways that we can measure the financial assets. It's either we can measure financial assets at amortized cost, or we can measure financial asset at fair value through profit or loss, or we can measure our financial asset at fair value through other comprehensive income. Okay, so we are saying that at amortized cost. So when I'm looking at amortized cost, right? As the word says, I'm trying to say that this is spread over the period. No, this is spread over the period. So when you go and purchase a car, you go and purchase a car, right? When you go and purchase a car, then you say, you know what? I want to purchase this car and it's 500,000. When we say 500,000, we are looking at the today's value. Then at an interest rate of 13.5 or whatever, the interest rate that might be. So when you are paying for this loan that you used to finance the car for, each and every payment that you are making there, it comprises of, number 1, interest as well as the principal, right? So we are saying that the financial, the instrument has been spread over the period. So when you're making the payments that you're making 5,000, but included in 5,000, there is a portion for the capital, and there is a portion for the interest. So they say that a financial asset is measured at amortized cost. A financial asset shall be measured, or is measured at amortized cost if both of the following are met. Okay. Number 1, the asset is held within a business model whose objective is to hold asset in order to collect contractual cash flows. That's number 1. Then number 2, the contractual terms of the financial asset give rise that are solely payments of principal. Let's highlight that. Principal and interest on the principal amount outstanding. So what they are telling us is that if you go and purchase shares into a company, right? when you go and purchase shares into the company, right? And you say that, you know what? These shares that I have are going to fluctuate in the value of the shares. So in other words, I'm holding the shares because I'm going to sell these shares at some point so that I can get the cash flows, right? But I'm going to determine on the movements of the price for each share. So in other words, I'm trying to say that yes, the business model is to hold the asset in order to collect the contractual cash flows, because I'm holding the shares, right? To say that, okay, if they fluctuate and goes up, I'm going to sell these shares, right? I'm holding the share, right? In order to collect the contractual cash flows. So in other words, at some point, I'm going to sell these shares, then I get the money. That's what number one is trying to say, is to say that, okay, the asset is held within a business model whose objective is to hold the assets in order to collect the contractual cash flow. So I'm holding the asset. I'm going to sell it at some point. Then I get the what? I get the money back. Then number two now is now telling us that, okay, when I'm holding this share that I have, right, does it give rise on a specific date on interest? Because remember the first example that I gave, I say you go and take a loan. And when you go and take a loan, the amount that you are paying has been spread over the certain period. To say you're paying 5,000 per month. But included in 5,000, there is the capital, then there is the interest, right? But when I'm looking at me purchasing shares, right, the only thing that I'm looking at is the capital. There's no interest that is going to give rise to the shares. So when I sell the shares, there's no interest. So there is no interest that is going to arise from these shares, but only the capital. But when I'm looking at the loan that I took, yes, there are solely payments of principal and interest. I'm saying that the 5,000 that I'm paying per month, what does it include? It includes the principal amount and it includes the interest. So we are saying, okay, let's measure that financial asset at what? At amortized cost. In other words, I'm trying to say I give you a loan, right? And I give you a loan of 500,000. Then I say, no, what? The 500,000, you're gonna pay me interest per month for 500, and at the end you're gonna give me back my 500,000. So what does it mean? It means that the contractual terms of this financial asset that I just gave you, it gives rise, one, on specified dates. When am I going to pay you interest? To specified dates, to cash flows that are solely payments of principal and interest, right? So in other words, the interest is calculated on the amount that is owing. So when I'm saying that interest is per month, per annum, I'm giving rise to a specified date that you're going to pay the interest. When I say the principal amount, you pay it back at the end of 5-year period, I'm giving you a specified date to cash flow of the principal amount. So in other words, the interest is going to come monthly, the principal amount is going to come at year 5. So that's a financial asset that is classified as measured at amortized cost. In other words, I'm trying to say that the financial asset is spread over the period, and when it is spread over the period, and I'm going to pay an amount that includes the principal and the interest, I'm going to pay the interest and the principal on a specified date. Are we together?
Yes, sir.
Okay. Then, when I'm looking at fair values, right? That one was amortized, right? When I'm looking at fair values, right? When we say fair value through profit or loss, right? When we say fair value through profit or loss, we are trying to say that I have purchased shares, but these shares that I purchased, they are for speculative purposes, right? In other words, when I'm saying speculative purposes, I'm trying to say that the moment I see that the value of these shares is going up, I sell. The moment I see that it's going down, I purchase. You know, so in other words, I'm trading in shares, right? And the movement of these shares is going to other income. The movement of these shares, you purchase the shares today, 3 Rand per share. Tomorrow at year end, they're 4 Rand per share. The movement of these shares is through other income, right? Then I have fair value through OCI. We know what goes to OCI. Fair value through OCI, right? So in other words, when we spoke about OCI, we are talking about things that have capital appreciation, right? So the moment we talk about capital appreciation, we know that with our CGT, the 80% kicks in, right? Because remember, the other comprehensive income is disclosed already after tax. So the amounts that you put there should be net of tax. So you should not forget that. Should they say present a profit or statement of, you know the question that they gave us in the first assignment to say that present this in the statement of financial position, right? They can also say present this in the statement of profit or loss. In other words, you're trying to say that, okay, which line items are affected by this transaction, right? It's no longer, guys, just about workings. Okay, I work 1 + 1, I get the 2. You also need to understand, how do I explain this concept through? The exams that they're asking us this time, going forward, they're more of theory, your understanding, more than the calculation itself. Okay, so we just need to be careful. Not yield for trading. Obviously not for speculative purposes. Okay. Do you have any questions there? Do you have our financial calculators?
So
Yes, I have mine.
Okay, because we need to calculate the present value. We need to calculate the present value. All right. Then when we purchase this financial asset, right, there is transaction cost, obviously, that are incurred. You know, there are transaction costs that are incurred. So you also need to know what is the treatment of the transaction cost that the business have incurred, right? You know, so when I'm talking about transaction cost, I'm talking about those legal fees that you enter into, or that you pay, right? Transaction cost. So if a financial asset is measured through profit or loss, you expense the transaction cost. Expense transaction cost. All right. In other words, I'm trying to say that you debit financial asset, you debit the transaction cost expense, then you credit your liability into your bank, right? Okay. And then if an asset is measured through OCI, right? So here you capitalize transaction cost. Transaction cost. Then if an asset is measured at amortized cost, you capitalize transaction cost. Yeah. All right. Do you have any questions before I move to compound financial instruments? I think that's where I'm going to lay my legs for tonight. Do we have any questions before I combined?
Yes, sir, I have one. Sir, can you please repeat the explanation of the fair value through OCI?
Through OCI. Okay.
Yes.
So we are saying that when a financial asset is measured through OCI, right? So basically, I'm looking at when you measure what do you call this? When you measure when you measure assets, right? When you measure PPE, right? You have a way to say, you know what? This PPE is a depreciable asset, and this PPE is not a depreciable asset, right? But when you get to land, what are you gonna say? You're going to say, no, the land, because of its characteristic of the land, with the fact that the land can keep on going for years and years, it means that I'm holding the land for capital appreciation, right? Okay. So that's the same thing that I'm talking about when when it comes to through financial asset through OCI. I'm saying that when you have financial assets that are designated through other comprehensive income, we are saying that for you actually to say you are designating this financial asset through OCI, obviously at some point you're going to sell, but also it determines when are you going to sell this financial asset. Are you going to sell them the moment they goes up or down? You know, for profit motive, that's a profit or loss. If it's not for profit motive, but for capital appreciation, to say that, you know what, I'm purchasing shares in this company. Why? Because I have a belief that this company is actually gonna grow. As it grows, my share in that company is also going to grow. That's other comprehensive income. In other words, the intention behind the shares that you've purchased, it's not for you to sell it, but for capital appreciation. I'm not sure if I'm still with you.
Yes, we're still together.
All right. So that's
And also, what I would like to check is,
yes.
okay, what I would like to check is whenever there's a question clear for us to understand the intention of purchasing those shares, or they tell us.
Let me check
Or
this.
depending on the question, what the question will say.
It depends on what the question is saying. Sometimes they might not be clear, but you have to look into the question. Let me just say, in an effort to raise funds required to expand and also meet operational Acquify issued 1,000 debentures. Also, yes, the debentures are convertible. Market related, the convertible debentures. Okay, okay, no, it's fine. We'll just talk about it. But sometimes they don't specify.
Right.
So what happens sometimes is that you look at a transaction and you start with amortized cost, right? If it does not meet amortized cost, you go to OCI. If it does not meet OCI, then it definitely is profit or loss, right?
Okay.
So I'm gonna try to explain the one that is on our left here.
Okay, thank you.
Okay. Another question, guys, before I go to our compound convertible. All right, if we don't have questions, then guys, what happens at times is that the business can issue out what is known as debentures. What is known as debentures, right? So with these debentures, right, they are a form of loan that is in units. A form of a loan that is in units. In other words, what am I trying to say? I'm trying to say that I can have 10,000 debentures, right? If I want to raise 10,000 rands, right? Instead of going and take a loan from the bank, I can have 10,000 people who are giving me 1 rand each. Are you understanding what I'm saying? Instead of taking all the whole loan from Absa, I can go to the people in the public and say, guys, I have 10,000 units here. Each unit is worth 1 rand. So all of you come and pay. So 10,000 people will come pay 1 rand. Now I have 10,000. Is it making sense?
Not so really.
Yeah? Because we need to understand what
Not
are
really on my
debentures.
side.
Yeah?
I'm saying not really on my side.
Okay, I'm saying that you want to raise finance, right? No, you want to raise finance. You want 100 rand, right? So either you can go to the bank and take a loan. It means now you have money and you're owing the bank. Do we agree? You're going to debit the bank, you're going to credit loan. Do you agree?
Yes. Yes.
Okay. So now we are saying that of that 100 rand, I can get it, in other words, by issuing 100 units. I can create certificates, that are written on Washington, 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 and there are 100 of them. And I say to you, Lou, come take 50. Then I say in Tombi, come take 50. So that means Lou is holding 50 debentures, Tombi is holding 50 debentures. Lou gave me 50 rand, Tombi gave me 50 rand. But I now have 100 rand. But how did I raise this 100 rand? I raised this 100 rands by issuing out some units. It's like shares, and I'm getting the money back. I don't know if you understand that.
Yes. Yes.
Okay, so now what happens now, Lou, is that these debentures, they carry a certain rate, what we call the nominal interest rate. In other words, I'm trying to say that, yes, Lou, you're giving me 50 rand for 50 debentures. Per year, I'll be giving you 10% of that 50 rand. In other words, per year, I'm giving you 5 rand. That's the nominal interest rate, which is the PMT. Right. Then we also say, no, you know what, Lou? Since I'm giving you 5 rand every year for the next 5 years, at the end of 5 years, since you have 50 debentures, since I gave you 50 units of debentures, why don't we convert those debentures into ordinary shares? That's a short left. Why don't we convert that debenture into ordinary shares at the end of 5 years? So what does this mean to me, Lou? It means that You gave me a loan today at day 1. But at day, after 5 years, I'm going to give you shares. So my question is, Lou, do I have a liability in regards to the principal amount of the loan? I'm asking all of you guys, you can answer. Do I have a liability on the principal of the loan, of the debentures?
I don't think it's
Because I'm saying to you that at the end of 5 years, I'm not going to pay you. I'm going to erase that debt by giving you shares. So I don't have a liability.
No, there's no liability because
the liability that I only have is the interest, because I need to pay you 10% nominal interest rate for the next 5 years. But the principal amount, 50 Rand, Lou, I'm not going to give it to you. I will say you now have 50 shares. You now own 50 shares in my company. I'm not giving you the 50 Rand. Right. So now, we need to know now to say that, okay, my PMT is 5 Rand for the next 5 years. That's my liability component that I have within this contract. But at the end of 5 years, between me and Lou, who have the option to convert those debentures into ordinary shares. So number 1, we have a scenario where there is an automatic conversion. Number 2, conversion in the option of holder. Number 3, conversion option of issuer. So in other words, I'm trying to say to you, Lou, that of the 50 debentures that I have given you, I have put a condition in those debentures, number 1, to say that at the end of 5 years, all debentures are going to be automatically converted to ordinary shares. So when there is an automatic conversion, it means that I don't owe you 50 Rand at the end of 5 years. There's no liability component. It means that that 50 Rand will form part of equity component. Do you understand?
Yes.
All right. Let's start again with the diagram. I'm saying that we have 2 people, or we have 2 companies, right? This is my day 1, and this is my day 5 years later. Right. Okay. So I'm saying that I give you we issue debentures here, right? But these debentures, they are 50 Rand, a nominal of 10% per annum, right? Then they say that these debentures, they are automatic conversion. So if there's an automatic conversion, it means that the business have avoided payment of the 50 Rand at the end of 5 years. But there's no way that they're going to avoid the interest. So that means the liability component here will be what? Interest. So in other words, the future value here will be equal to 0. I'm not going to pay you anything. So the future value is equal to what? will be equal to 0. Okay, that's number 1. That's an automatic conversion. Then number 2, we are saying that conversion is in the option of the holder, right? So when conversion is in the option of the holder is Lou, is the one who has the debentures. That's the holder. I'm the issuer because I'm the one who gave her the debentures. But she's the holder, right? To her, what do you think she's going to do after 5 years? There is a conversion, but the option to convert is in the hands of Lou. What is she going to do after 5 years? What do you think, guys? What do you think Lou is going to do after 5 years?
Is need to decide whether need cash or
Lou,
to convert them to shares.
yes, that's correct. Lou is going to sit at day after 5 years later to say that if I give these guys the debenture back, they're going to give me 50 rand. But if I convert this debenture into shares, the shares are worth 250 rand. So at the end of 5 years, Lou is going to weigh the options to say which option can benefit me. So at this point in time, the business have no direct avoidance to pay cash at the end of 5 years because Lou can decide to say, no, the value of your shares are lower. Please give me 50 rand. I want my debenture, I want my money back. So it means that here, the future value will be 50 rand. Because at this point, we don't know what Lou is going to do. Lou can decide to say, no. 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 Give me back my 50 rand. Or Lou can decide, yeah, let me convert them to. But we don't know what Lou is going to do after 5 years. That's number 2. Are we together, guys?
Yes, we're together, but can I check something? So if the future value is gonna be 50 rand, so is that the worst case scenario, or is what is or we just need to measure what is what to say monetary value of the repayment of the principal?
Remember, they will tell us, right? Let me see if here they told us so that you may. You see here they say that the debentures are converted at the option of the holder into 100 ordinary shares for each debenture. The debentures are redeemable at par on maturity. So you need to go back and say, what was this par? Then you go back, they say, IQ Farmers issued 1,000 convertible debentures at their par value of 350 each. So that means they will be redeemed at par value, which is 350 each, and there are 1,000 of them. That is the future value. Do you understand? In other words, when we say the future value, we are saying that how much would they be redeemed for?
Okay.
Are we together? Okay. Then number 3, in the option of the issuer, we had a disagreement with the lecturers last semester when it comes to to the to the option of the issuer. But however, they said that when the option is in the hands of the issuer, in other words, we're saying that the debentures that they've issued out have an option to be converted to ordinary shares at the end of five years, but it is in the option of the issuer. They are saying that if it is in the hands of the issuer will always choose the cheapest option for them, which is true, and their cheapest option is always to convert to ordinary shares. So in other words, they are saying that if it is in the hands of the issuer, we are going to convert to ordinary shares. So in other words, if we are going to convert to ordinary shares, the future value will become 0. The future value will become 0. They say that because the option to convert to ordinary shares does not touch the bank, and the issuer will always want to be in a position where they are not paying out the monies, and they are reserving their reserves. So they are saying that so they do not have to lose the money to settle the obligation. So if it is in the option of the issuer will convert to ordinary shares. All right. So basically, that's our convertible. Sorry, that's our compound financial instrument. So when we say compound financial instruments, we are saying that in this financial instrument, there is an equity and a liability component. So in other words, a compound financial instrument. So in other words, a compound financial instrument. A compound financial instrument. Instrument is a contract that gives rise to a financial asset of an entity and financial liability. Here we have earned equity component of another entity. Another entity. Okay. All right. Do you have any questions? Okay. So let's look at our example. Let's look at our example for our financial instruments. Okay. Okay. So let's read it together. In an effort to raise funds required to expand and also meet operational needs, right? IQ Farmers Limited issued 1,000 convertible debentures at their par value of 350 each at 1 February 2024 to Gomet Limited, right? Gomet Limited also has a 28 February year end. Gomet Limited incurred transaction cost of 2.5 on this transaction. Transaction costs incurred by IQ Farmers are negligible. The debentures are converted at the option of the holder into 100 ordinary shares for each debenture. On 31 January 2029, the debentures are redeemable. The debentures are convertible at the option of the holder, right? And in this case, the holder is IQ Farmers, right? The debentures are convertible at the option of the holder into 100 ordinary shares for each debenture. On 31 January 2029, so here this happened 2024, 25, 26, 27, 28, 29, 5 years later. The debentures are redeemable at par on maturity. Coupon payments of 9% per annum will be made annually on 31 January. That means at the end of 1 year, we'll make coupon payments of 9%. On 1 February 2024, the market-related interest for similar debentures without a conversion option was 11.5% per annum. So this would be our interest for the purpose of calculating what? For the purpose of calculating our present value in the books of IQ Farmers. Each convertible debenture had a fair value of 335 and 363 at 28 February 2024 and 28 February 2025 respectively, right? So guys, we have Gomet, right? We have Gomet, right? And then we have IQ Farmers, right? We have Gomet and we have IQ Farmers. Yeah. IQ Farmers, they're the ones who sold these debentures to Gomet. So in other words, in the books of IQ Farmers, right, they've received, in other words, these guys have received money. But in the books of Gomet, they've paid, right, bank. So Gomet is sitting with a credit bank and is sitting with a debit financial what? Financial asset. Then IQ Farmers is sitting with a debit bank and credit liability and equity. I don't know if you will understand that.
Explain, sir.
I'm saying that. Let's read the first paragraph. The first paragraph says, in an effort to raise funds required to expand and also meet operational needs, IQ Farmers issued 1,000 convertible debentures at par value of 350 each on 1 February 2024 to Gomet Limited. Gomet Limited incurred transaction cost of 2,500 on this transaction. The transaction costs incurred by IQ Farmers Limited are what? Are negligible. So we are saying that IQ Farmers was holding debentures and go and give them to Gomet. Gomet is holding those debentures and give IQ Farmers money. In other words, they gave them money. Do we agree there?
Yes. So you issue those receive money.
IQ Farmers, it's a receipt. They're receiving the money. But what for? For a liability. You know, what for? For a liability.
Yeah. Okay.
Right. On Gomet, they are paying money. What for? For a financial asset.
Financial output.
Right. That is the financial asset that we need to determine in the books of Gomet to say, in the books of Gomet, is this financial asset measured at amortized cost, other comprehensive income, or profit or loss in the books of Gomet? So we need to understand the business model in the books of Gomet to say that, okay, does this gives rise to principal and interest at specified dates?
In this case, I think it's a yes.
How is it a yes? In the books of Gomet.
No.
Because at the end, they even told us that each convertible debenture had a fair value of 335, 363 at 28 February and 28 February. So in other words, they're also Gomet is looking at the price. They're looking at the price of the debentures. You know, is it going up or is it going down? So in other words, on Gomet's side, if I have to prepare financial statements for Gomet, it means that at some point I might end up having a fair value adjustment going up or going down.
Going down, yes.
It was 350, went down to 335. Now it's 363. You know, so okay. Let's look at our amortized. Let's go back to our amortized. We say that a financial asset should be measured at amortized cost if both of the following are met. The asset is held within a business model. Its objective is to hold assets in order to collect contractual cash flows. Okay. So the contractual terms of the financial asset gives rise on a specified date to cash flows that are solely payments of principal and interest on the principal outstanding. So they're saying it's principal and interest on the principal outstanding amount. So we are saying that no, the contractual cash flows of the debentures are not solely payments of interest on the balance outstanding, of principal and interest on the balance outstanding on the debentures, right? But also they have an option to convert into ordinary shares. So we are also looking at the going up and going down of the increase and decreases of the values of shares in IQ Farmers. So the payments that we have, they are not solely principal and interest on the balance outstanding. Then they also say that
That is in the.
yes.
I was just trying to say that is in the book of Gomet.
Come again?
I was just saying in the books of Gomet they
Yes, we are in the books of Gomet. Remember, in the books of IQ Farmers, this is a liability. So liability is at amortized cost.
Okay.
A liability is measured at amortized cost. Then equity, we don't even know, because it's just equity. A liability is at amortized cost. But so when we're talking about the financial asset is the one that we need to determine whether it's amortized cost, or it's what do you call this? Or it's through other comprehensive income, or it's through OCI. So they also say the financial asset is held within a business model whose objective is to achieve by both collecting contractual cash flows and selling financial asset. That is for other comprehensive income, right? So they went on to say that if a financial asset fails to meet the recognition criteria of an amortized cost, it cannot be subsequently measured at fair value through other comprehensive income. It means that it will be fair value through profit or loss in the books of GOMET. It means that if it fails the amortized cost, it cannot be subsequently measured at fair value through other comprehensive income. It means that it will be measured through profit or loss. So at initial recognition of the financial asset, it means that the initial recognition, it will be measured at fair value through profit or loss. The transaction cost of 2.5 on this transaction will be expensed. We say that if an asset is measured at financial asset through profit or loss, it means that the transaction cost will be expensed. Then the gains or losses that arises from this financial asset will be through profit or loss. So in other words, if it's a loss, it's an expense. If it's a gain, it's other income. So in other words, we have a loss on fair value, or we have a gain or at what? At fair value as well. Okay. Then what I want us to look at right now is since we are already discussing in the books of GOMET, it's not going to be that difficult because you already know that it's a financial asset, right? So I'm going to be like, okay, in the books of GOMET, it's not going to be difficult because I just have a financial asset, right? So as I have a financial asset, it's how much? 350 times 1,000 in the SFP. 350 times 1,000. That's 350,000, right?
2,000 is
Then I have transaction cost. In the
2.5.
P&L, 2.5. Then obviously I have my bank 352 500, right? This is happening on 1 Feb 2024. All right. Then at 20, when is our year end? Our year end is 28 February, right? So if there is anything that happens at year end, I'm looking to say that, okay, at the beginning, the fair value of these shares was 350, right? At the beginning, the fair value of these shares was 350, but is now 335 at 28 February. It means that it went down, right? So this is what? This is a loss on fair value adjustment, right? Loss on fair value adjustment. In the P&L. Then what goes down is my financial asset. This is in the statement of financial position. So here I'm going to say 350 minus 335 times 1,000. How much do I get?
15,000.
15,000. 15,000. Okay. Then I do the same for 28 Feb. 28 Feb 2025. Right. Obviously here it went up 363, right? So I'm looking at financial assets going up. Financial asset going up in the statement of financial position. Then I'm looking at a gain on fair value. So I'm going to say 363 minus the last time I measured was 335 times 1,000. How much do I get?
28,000.
28,000. So in the books of Gomet, this is not going to be much of a challenge. This is not going to be much of a challenge. Right. And you calculate how much is our finance income. They say interest is paid when on 1 February. Paid on 31 January. Right.
January.
31 January. So in other words, we need to say, okay, before I have 28 February 2025, I think I had 31 January 2025. So here I skipped the journal here. So at 31 January 2025. Right. So my interest is going to come to my bank. And I say finance income in the P&L. Then how much was it again? It's 350,000 times what percentage? Times 9%. What do I get?
It's 31,500.
31,531. Okay. So in the books of Gomet, I don't think it's gonna be difficult. But let's look in the books of IQ Farmers. That's where I was laying my legs a bit, right? So that we look at in the books of IQ Farmers. Okay, so in the books of IQ Farmers, what we need to do is to calculate the liability component first. And calculate the liability component first, right? How do we calculate the liability component? By calculating the present value of all of our obligations. We calculate the present value of all of our what? Our obligations. So in other words, here they said that the debentures are convertible at the option of the holder. So if debentures are converted in the option of the holder, it means that at this point, we don't know. We don't know. So our future value is equals to 350 times 1,000, which gives us 350,000. And how many years?
You said 5.
Yeah.
You said 5 years.
So it's 25, 26, 27, 28, 29. So it's 5 years. That's correct. Then interest is the market interest rate. What is the market?
11.5. 11.5.
5. $11.5. Then PMT, you say 350,000 times what?
Times 9.
Times 9%. What do we get?
31,500.
31,500. So what is left is our PV.
I'm getting a PV, not sure if it's right.
You're getting what?
It's not right. I think it's correct. Let me recalculate. So our PMT is OIQ farmers will be negative, right?
Okay. Isn't it that we are going to pay, and even the future value are going to pay?
Oh, okay.
So
Yes.
both, I think they should have the same sign.
Okay.
I'm not sure.
Okay. Yes, yes. Mhm. Mhm. It's I'm getting a PV of 318,063.57.
318
064.
64. Okay. So when you get here, you have the future value. $350,000. Then the 318,064, that is the liability component. $318,064. Then the difference is the equity component. How much do we get?
It's 31,936.
31,936. Right. Once we are here, this is what we do. Remember, we are IQ farmers. We are the ones who received money in the bank of 350,000. And we said that in that 350,000, there's a liability component of convertible debentures. The statement of financial position of 318,064. There's an equity component of debenture. The statement of financial position of 31,936. This is happening at 1 February 2024. So, whilst we are here, the liability component, okay, is interest. So we have to do an amortization table. So let's come here. Going to have our balance. I always like capital to be here. What else? What else? What else? What else?
Interest.
Interest. But we cannot have capital. We cannot have capital. Wait. It's balance, interest, then the PMT, which is our installment. And on 1 Feb 2024, with 318,064. All right. When is the year end? So when we are doing amortization table, we look at what comes first, year end or a payment date. Right. We have year end or a payment date. With year end or a payment date. So what comes first?
Yeah, the payment
Payment
date.
date.
When is our year end?
28 February.
So from 1 February, what comes first?
28.
Oh,
It's
28
end.
February, the year end.
28.
So we have 28 February 2024. Right. And on this day, I'm going to say 318,064 times 11.5% times 1/12 of incurred interest. How much do I get?
Risa, can you repeat? Times 11.5.
Come again?
times- I'm getting 3,048.
3,048.
48.
So 318,064 plus 3,048.
One.
It's 321, 112.
321.
112.
1.
112. So what comes next? Payment date or year end? In this
Payment
case,
date.
payment date 31 January 2025. And I'm going to say 318,064 times 11.5% times 11/12.
It's 33, 529.
33,
529.
yes, 33, 29. So
That's
321, 112, 33, 529. How much do I get? Wait, included in 33, 529, how much have I paid? I've incurred interest of how much? How much is the installment? I paid 31,500. So how much is my closing balance now? How much will be my closing balance? For my closing balance, I'm going to say 321,112. 321,112 plus 335,29 minus 31,500. How much do I get? Or I can just simply subtract the two. To say 33,509 minus 31,500. Then I add to 321. How much do I get?
I'm getting 323,141. It's 321,112 plus 33,529 plus 31,500. 323,141.
323.
141.
Okay. So what you need to know now is that this is the finance cost for the year. For 28 Feb, wait, before I say that, because we need to put our timelines, isn't it? Because there's 1 year that goes outside. So we need to be very careful when you have something like this, because this is our year end, right? Oh, so we need to do another one again. We need to do another one for us to reach year end, because we have 28 Feb 2025. Remember, that's year end. So when we come here, we're going to put a line to indicate that this is the year end. So here we're going to say 323,141 times 11.5% times 1/12. What do we get? It's 323,141 times 11.5% times 1/12. What do we get?
I'm getting 3,097.
Okay. So now, if we come here to say 28 Feb 2024, right? What am I going to have? 28 February 2024, it's here, right? This is 28 February 2024. I have interest. There was no payment that was there. So I have finance cost in the P&L of 30,048, right? That give rise to a liability component. I'm just going to say liability component. In other words, it's liability component of convertible debenture, right? In the SFP, 3,048. This is what happened in 2024 financial year. There was no payment that was received or that was paid. Then in 2025, which is now in green, there are two transactions that happened in 2025. There was payment that was made, right? That reduced our liability component. So we made a payment and we reduced our liability component in the statement of financial position with 31,500. Then we say bank in the SFP, 31,500. That's the first transaction that happened. The second transaction that happened was that we incurred interest If you look between the red lines, there is finance cost. In the P&L. And then there is liability component. SFP. Right. So I'm going to say 33,529 plus 3097. How much do I get?
It's 36,626.
It's 36?
626.
626. 36, 626.